G'day guys, Seeney here and welcome to another episode on the Australian Wealth Channel, and today we are talking about how I actually built a $5 million property portfolio. Everyone celebrates when their property goes up 80%, but the real question is, how much money did you actually get? So for those that are joining me for the first time, my name is Jay. I live here in Sydney. I run a video production business and I've built a real estate portfolio that's worth about $5 million. And in this video, I'm going to break down how I actually did it. And the crazy part about this is that I've only put in about $350,000 of my own money. That's an over 600% return on equity. With some of the tricks and tips in this video, you'll probably be able to grow quite a large portfolio as well. So my property journey began back in 2019 when I was looking to build a house with my wife, Andrea. So my business had started to do pretty decently. We had our first year where I had over $100,000 in income, and Andrea had been saving for a very long time for the deposit. So we combined our finances together and we purchased a property here in Campbelltown for $819,000. So that settled at the end of 2019, and then we had all of the building which took place throughout 2020. So at the time, we lived at home. So for this first property, it was a 20% deposit. So we put down about $200,000 of our own money. However, as the build process was happening, I had a lot of extra cash that was piling up. So I said to Andrea, well, we've done it once. Why don't we continue? Why don't we go and get an investment property? So that's essentially what we did. So we started working with a buyer's agent who sourced us a property up in Queensland in the suburb of Thornlands. So this was a house and land package, and I know that a lot of people on the internet will go against house and land packages saying they're overpriced and whatnot. But this actually worked pretty well with our strategy because I didn't want to deal with the maintenance of something that was already pre-existing, any issues that may crop up. It's nice to have something that's new, and that way the warranty can take care of any issues if there are any. So we bought this one up in Thornlands for $547,000. And looking back now, that's an incredible price compared to what it is. So this property in Thornlands was 10% down. So all in, we were looking at about $65,000. And these two properties were the most important in the entire portfolio because what they did is they created the equity base for me to continue buying more properties in the future. So I'm sure a lot of people remember 2020, and it was quite a scary time for the economy. COVID had came and we didn't know what was going to happen. The economy was in the toilet. The government was printing so much money. But during that time, I did my research. I knew that what happens when governments print a lot of money is the value of assets go through the roof. And that is essentially what happened. We had interest rates drop through the floor and the government flushed the system with so much money. I knew that this was going to drive prices up. So essentially, I just went on a buying spree. And in the next couple of years, I picked up another property in Queensland over at Springfield Lakes. And then I picked up another property again over in Adelaide. And it turned out that that was in fact a very good decision to go and do that. Our Springfield Lakes townhouse is actually the best performing property in our entire portfolio, which kind of defies logic because most people think, well, houses are going to appreciate faster than units. But it just goes to show how important location is for the heavy lifting of property values. This particular property sits right on a lake in Springfield Lakes, and people are willing to pay a large premium for that. So the property that we bought in Springfield Lakes, we got for about $365,000, and that is now worth over $800,000, probably close to $850,000 based on comparable sales. And at the same time, we bought one over in South Australia in Monopara West. That has also performed really well as developers have driven the price up over the last few years, and there's been a real lack of supply in the area. So essentially what I did to fund the purchase of two properties at the same time is I continued to work. My business was throwing off income for me, which was great, but also I pulled out equity from one of my other properties, so that way we could use that as the deposit to acquire another property. So the first one is definitely the hardest because you actually need to save up the deposit and there's no way of getting additional equity out of a property. But essentially, I've continued to use equity going forward, which has allowed me to accumulate more. So at the moment, I have 5 properties total. So that was 4. The 5th one, I transitioned into a commercial property. So we managed to pick up a commercial unit in Nerang on the Gold Coast for $365,000. And this was a good one because it was a little bit older, which means that we could fix it up, add some value, and it was also under market rent because it was a little bit older. So essentially, because the value of a commercial property is so tied to the rental income, we were able to make some improvements to the property, and we got some new tenants in that also did some improvements of their own and are paying basically market rent now, which has driven the value of that property up about $100,000. You could resell this one for $465,000 now, and that's only in the space of a year and a half by just adding value and making some repairs and just bringing it up to market rent. So the yield on this is now over 6%. I was slightly under 6% when we got it, but it's just one of those things. So our property in Nerang is funded completely by other people's money. The initial deposit was funded by a cash out refinance from our Campbelltown house, and the rest of the money was put up by the bank. So essentially, I've used other people's money to buy a property for me, which is appreciated in value, which is not only paying for itself, but is also going up in value. So this journey started about 6 years ago, and over time, the devaluation of the currency and the reduction in debt, because I'm paying principal and interest on a lot of these loans as well, has allowed my property portfolio to increase quite dramatically, to be honest. So we bought this house here in Campbelltown for $819,000. It would now resell for about $1.5 million. The one in Thornlands we bought for $547,000. That would probably resell for over $1.1 million now. The house in Adelaide that we bought in Monopara, we bought for $407,000. That could easily resell for over $700,000 now. And our property in Springfield Lakes that we bought for $385,000 would now resell for over $830,000, which is crazy. But you know, that's just what they did to the currency, and I saw that one coming. On the investment side, this property portfolio doesn't actually cost a lot to hold. It's about $22 a day on the investment side. On the prime place of residence side, you know, obviously we have a mortgage attached to this, but of course the gains on this are also completely tax-free. So the annual shortfall is about $8,000 a year. So it costs me $8,000 on my investment portfolio to control millions of dollars of real estate, of which the entire portfolio is growing at a rate of over $300,000 a year. So essentially what I'm going to do over time is I'm actually going to take this property portfolio, we're going to burn it down to the ground. And you might be asking, well, why the hell would you do that? Because at some point you don't need more growth, and what you need is cash flow. So anyone that's a real estate investor over time really needs to move away from residential and move into commercial, because the yields are significantly better. On a place like in Thornlands, our rental yield will probably be around 3 or 4%, which after the cost of debt, not so great. But in the commercial world, you're looking at yields that are closer to 6 or 7%. So let's say we have $2.5 million of equity that we've been able to get over time after selling down, paying capital gains, and all that kind of thing. So we can go and buy a $6 million commercial building. So obviously we're borrowing money to be able to finance something that large, and we'll be paying interest on that. But we'll be making a 6 to 7% return on the $2.5 million of equity that we have in the deal. So if I do some quick maths, on a 7% interest rate, $2.5 million is about $175,000 in passive income a year. So essentially, my strategy is to take that $175,000 for a couple of years and use it to pay down some of that excess debt on the property. And doing that will allow us to then generate even more money the following year. So the first year it might be $175,000, pay down some debt. Next year it might be $190,000, and so on and so forth. Meanwhile, the value of that commercial property is continuing to grow because the rents will drive it. In a lot of commercial agreements, you'll have a rental increase of 4% a year. So one year you'll be making, say, $100,000 or $200,000, whatever it is, and the next year it'll be $208,000, and then the year after that it'll be $216,000, etc., etc. So what that does is it drives the value of the property up. So the following year, your property might be worth another $100,000, another $200,000 because of that increase in rent. So it's not only a good way to get cash flow, but you're also increasing your net worth at the same time, which helps to increase cash flow more. So that is essentially my strategy. It's taken some time, like anything. if you want to build something that lasts, it does take time. So if you're still on your first property or working towards your first property, just know that that is the hardest step. Continue to save up that deposit. You don't need to invest in the city that you live in. It might be much more affordable for you to invest in Brisbane. Maybe not so much anymore, but maybe it's Perth, maybe it's another area. Just make sure that you're not buying dog shit properties. Buy something that people actually want to live in, and over time that property is going to continue to grow in value. So I'm expecting, over the next probably 7 years or so, the value of our assets will increase from roughly $5 million to $8 to $10 million. And then we'll be able to continue to purchase more commercial properties in the future until we decide that that's enough income for us to do pretty much whatever we want. So I hope you guys enjoyed this breakdown. If you have any questions about how I did it or how you can do it, then please put it in the comment section. I'd be happy to help you. My name is Seeney from the Australian Wealth Channel, and we'll see you later.